Imagine a colossal Chinese banking giant. Now, imagine it's up about 27% this year, nearly 32% over the last 12 months, and it's dangling a super tempting forward dividend yield of right around 5%. Sounds pretty compelling, right? Well, welcome to today's Explainer, where we are investigating Bank of China, specifically its US OTC ticker, BACFF. We're trying to solve a really interesting mystery today. Why on earth is a systemically massive bank with surging stock momentum and a 5% yield trading at such a seemingly cheap valuation? And maybe the most important question for anyone eyeing this stock right now, has the easy money already been made? Okay, let's dive into this. Here is our roadmap for today's investigation. We'll start with the Bank of China setup, look at its massive scale and international edge, then unpack the major hidden risks, circle a huge August earnings catalyst on the calendar, and finally, deliver the final verdict. All right, part one, the Bank of China setup. Let's take a look at the recent price action. The momentum we are seeing here is just undeniable. It's up 27.33% year to date. And honestly, if you zoom out to a full year, we're talking about a near 32% gain. This is absolutely critical context to keep in mind, because you are definitely not looking at a bottom fishing setup where you're scooping up shares after a major collapse. The easy money? Yeah, it might have already been made. When you look at the chart history, the long-term momentum is undeniably bullish, but the short-term momentum has actually cooled off a bit lately. So you've really got to ask yourself the hard question. Is there actually enough fundamental upside left in the tank to justify taking on the risk at these current prices? And, part of what keeps investors circling back to answer yes to that question is this highly attractive number right here, a roughly 5.03% forward dividend yield. For an income-focused investor, grabbing 5% annually at the recent OTC price looks fantastic on paper, but I want to throw up a quick caution sign here. A high yield is not automatically a bullish signal. Remember your basic dividend math. Yield goes up when the stock price goes down. Sometimes a super high yield just means the broader market is expecting trouble and is pricing the stock down on purpose. Also, just a quick pro tip for OTC stocks in general, always double check your specific security. Different depository receipt ratios mean you'll sometimes see varying payout amounts listed on different finance websites. Moving right along to Section 2, Scale and International Edge, let's look at their massive footprint. Look at this number, over 313,000 employees. To put that kind of wild scale into perspective, Bank of China employs roughly the same amount of people as the entire population of Pittsburgh. They are incredibly deeply embedded in corporate banking, personal banking, wealth management, you name it, global markets. This is just a staggering operational presence. And, as you might expect, that colossal workforce translates into an absolutely immense revenue figure. 659.9 billion Chinese yuan for the reference period. This number really drives home the core bull case for the stock. If you're an investor here, you aren't buying some speculative promise of explosive textile future growth. You're buying immediate, tangible value, massive recurring income, and unbelievable banking scale. It's a pure play on established financial infrastructure. But it's not all smooth sailing. Bank of China is essentially locked in a massive tug of war. On one side, they have this distinct international advantage. Compared to a lot of their domestic peers, Bank of China has a huge global footprint, which gives them diversification, foreign currency revenue, and tons of cross-border trade finance opportunities. That really helps shield them. However, on the other side, they face a severe domestic problem. Like pretty much all Chinese banks right now, they are battling brutal net interest margin compression. Banks make money on the spread between what they earn on loans and what they pay out to fund them, right? If lending rates fall, but funding costs stay sticky, that profit margin just gets squeezed. Throw in some heavy domestic real estate exposure, and you've got this fierce battle between their global strength and some very real local headwinds. Which brings us to Section 3, the major hidden risks. Now, what's really interesting about this slide is exactly how those macro threats actually hit the bank's bottom line. It works exactly like a chain reaction. Here's the fundamental domino effect of China's credit risk that you absolutely have to watch. It starts with step 1. Defaults rise, especially among those big property developers or commercial real estate borrowers. When that happens, boom, we immediately hit step 2. The bank has to increase its provisions, which basically means they have to set aside a bunch of cash to cover those bad loans. That directly forces step 3. Because all that cash is sidelined, net profit drops. And finally, step 4. Those dropping profits and rising bad loans significantly crank up the capital pressure on the entire bank, testing their financial buffers. And when we map out all those headwinds, here is what the risk scorecard actually looks like. I want to just lay these out neutrally so you fully grasp the environment we're dealing with here. Notice those flashing red warnings. Property exposure? High. Government and regulatory risk? High. Geopolitical risk? High. And meanwhile, that net interest margin pressure and the broader credit losses we were just talking about are sitting right there at medium high. So, let's be clear. These are not minor, everyday operational hiccups. These are severe, systemic macroeconomic challenges that Bank of China is being forced to navigate. Crucially, there is one more major risk here, and it applies very specifically to retail investors trading over in the US. Over-the-counter liquidity. While the primary underlying stock is incredibly liquid over in Hong Kong, this specific US OTC ticker, BACH, has terribly low volume. Recent data showed a 20-session average volume of only about 16,000 shares. That is a serious liquidity trap. You simply cannot assume that an OTC line gives you the same ease of trading as the primary listing. If there's a market shock and you suddenly need to exit your position quickly, that low volume can absolutely crush your execution price. All right, part 4, the August earnings catalyst. The resolution to our mystery comes down to one big date. We can actually trace the recent breadcrumbs, these corporate actions, leading right up to this moment. Back on July 15th, the bank updated its dividend documentation. Then, on July 22nd, they issued specialized capital bonds. That was a highly technical move specifically designed to strengthen those vital financial buffers we talked about earlier. On August 18th, they announced a board meeting. And all of this careful preparation perfectly culminates on August 28th, with the massive 2026 interim results release. Right now, the market is literally holding its breath, just waiting for these numbers to drop. When August 28th finally arrives, please do not just glance at the headline earnings per share. It doesn't tell the whole story. Here are the 10 exact metrics you need to scrutinize to really gauge the bank's true fundamental health. Obviously, look at net profit and revenue, but you've got to dig deeper into the relationship between net interest margin and non-performing loans, and check the provision coverage that's actually backing those up. You want to watch credit impairment levels hand in hand with their loan growth. Check to see if those capital ratios are still highly protective. And lastly, assess the dividend sustainability against whether their international business is growing fast enough to offset the domestic pain. If these 10 indicators remain healthy, the setup is highly bullish. But if you see credit impairments start to jump, consider that a massive, glaring warning sign. Which leads us directly into Section 5, the final verdict. So, the crucial point is synthesizing all of this into an actual framework. Here is our final investor scorecard, and it heavily contrasts some truly brilliant positives against those extreme fundamental risks we outlined. On the plus side, scale and international franchise along with valuation and dividend all earn a perfect 5 stars. They're rock solid. Earning stability holds up pretty well at 4 stars. Growth and capital position are sitting right at 3 stars. But down there at the bottom, those China macroeconomic, property, and OTC liquidity risks all score high. So when you aggregate all of this data together, the overall investor score lands at a very respectable 8.1 out of 10. Based on that scorecard, here's how you can approach the stock through some clear conditional scenarios. You look to buy on pullback if, and literally only if, the August 28 results are healthy, margins stabilize, and credit quality stays controlled. You hold if you're an existing investor and earnings and capital just remain stable. You've already got a really decent cushion from the recent run-up, so you're fine. You watch if you are a brand new investor. Seriously, do not jump in blindly before those August 28 numbers. And you sell or reduce if credit sharply deteriorates or that net interest margin just completely collapses. Never, ever hold a stock solely for the dividend. A 5% payout is absolutely not going to save you from a major capital loss if the underlying fundamentals break. I want to wrap up with this thought because I think it perfectly summarizes the massive stakes we've discussed today. The dividend is attractive. The valuation is cheap, but the next earnings report will tell us whether the discount is an opportunity or a warning. Listen, Bank of China has already handed investors some fantastic price appreciation over the last year. The easy money is very likely in the rearview mirror at this point, so I'll leave you with this question. With a 5% yield on the line, are you brave enough to step in before the August 28th reveal, or is the macroeconomic risk simply too high a gamble for your portfolio? Keep your eyes locked on the data, and thanks for joining me on this explainer.